Intel shares dropped by up to 20% in after-hours trading on Thursday, following the chipmaker's announcement that it will lay off more than 15% of its employees as part of a $10 billion cost reduction plan. Additionally, the company reported results that fell short of analysts' expectations. Intel also announced that it will not be paying a dividend in the fiscal fourth quarter of 2024 and will reduce its full-year capital expenditures by over 20%. Here's a comparison of the company's performance against LSEG analyst estimates. Earnings per share, 2 cents adjusted versus 10 cents expected. Evenue, $12.83 billion versus $12.94 billion expected. According to a statement, Intel's revenue fell by 1% year-over-year in the fiscal second quarter, which ended on June 29th. The company reported a net loss of $1.61 billion, or 38 cents per share, compared to net income of $1.48 billion, or 35 cents per share, in the same period the previous year. CEO Pat Gelsinger stated on a conference call with analysts that the decision to accelerate the production of Core Ultra PC chips capable of handling artificial intelligence workloads contributed to the company's loss. We had previously indicated that our investments to enhance and drive the AI PC category would impact margins in the short term, Gelsinger said. We believe these trade-offs are justified. We expect the AI PC market to expand from less than 10% today to over 50% by 2026. Furthermore, Intel has chosen to expedite the transfer of Intel 4 and 3 chip wafers from a plant in Oregon to one in Ireland. This shift will result in higher short-term costs, but is expected to yield a broader gross margin in the future, according to Dave Zinsser, the company's finance chief. Zinsser mentioned that pricing was more competitive than anticipated during the quarter. AMD, Qualcomm, and other companies have been working to capture market share from Intel. Intel's Client Computing Group, which produces PC chips, generated $7.41 billion in revenue, marking a 9% increase and aligning closely with the $7.42 billion consensus forecast among analysts surveyed by StreetAccount. The company noted that performance related to AI-friendly PC chips exceeded internal expectations and was projected to surpass 40 million unit shipments in 2024. The data center and AI unit reported $3.05 billion in revenue, a 3% decline, and below the $3.4 billion consensus forecast by StreetAccount. For the fiscal third quarter, Intel projected an adjusted net loss of 3 cents per share, with revenue ranging from $12.5 billion to $13.5 billion. In contrast, LSEG analysts anticipated adjusted net earnings of 31 cents per share on $14.35 billion in revenue. Zinsser indicated that data center revenue is expected to grow sequentially in the latter half of the fiscal year, as demand for traditional servers improves modestly. However, he also noted that consumer and commercial spending has declined, especially in China, and the ongoing focus on cloud-based servers for AI has led Intel to lower its 2024 total addressable market forecast. During the fiscal second quarter, Intel announced that Apollo would invest $11 billion in a joint venture for a chip manufacturing plant in Ireland. The company also unveiled the Xeon 6 server processors and the Gaudi 3 accelerator for AI tasks. Additionally, in May, Intel revealed that the U.S. Commerce Department was revoking export licenses for consumer items to a customer in China, widely believed to be Huawei. Intel stated that fiscal second quarter revenue would remain within the previously announced range of $12.5 billion to $13.5 billion, though it would be toward the lower end of this range. The outcome on Thursday aligned with this update. In a memo, Gelsinger stated that the job reductions, which will impact approximately 15,000 employees, will primarily occur this year. This represents the largest single job cut recorded on Layoffs.fyi, an industry tracker active since March 2020. Simply put, we need to align our cost structure with our new operating model and fundamentally change our operations, he wrote. Our revenues have not grown as anticipated, and we have yet to fully capitalize on significant trends such as AI. Our costs are too high, and our margins are too low. On an adjusted basis, Intel stated that it anticipates approximately $20 billion in cuts this year, $17.5 billion in 2025, and even more in 2026. Excluding the after-hours drop, Intel's stock has decreased by 42% so far this year, while the S&P 500 index has risen by nearly 14% during the same period. Intel Corp CEO Pat Gelsinger was straightforward in announcing a $10 billion cost-cutting initiative that will reduce capital expenditures and cut the workforce by 15%. In simple terms, we need to align our cost structure with our new operating model and fundamentally change our operations, he stated in a memo posted to Intel's website on Thursday. Our revenues have not met expectations, and we have yet to fully capitalize on major trends like AI. Intel will also suspend its dividend starting in the fourth quarter. The company stated in its earnings release, Intel reiterates its long-term commitment to a competitive dividend as cash flows improve to sustainably higher levels. Before the report, the stock had a 1.72% implied dividend yield. These announcements were made alongside the chip company's second quarter earnings report, which revealed a miss on adjusted profit and disappointing guidance. Following the earnings call, the stock plunged 19% during Thursday's extended trading session. A decline of that magnitude, if it persists through the regular session on Friday, would mark Intel's worst drop since the stock fell 22.0% on September 22, 2000. As ARM's stock slides, analysts advise maintaining confidence. Intel reported a net loss of $1.6 billion, or 38 cents per share, compared to a net income of $1.5 billion, or 35 cents per share, in the same period last year. On an adjusted basis, Intel earned 2 cents per share, while analysts had projected earnings of 10 cents per share. Revenue totaled $12.83 billion, down from $12.95 billion in the same quarter last year. The FactSet consensus estimate was $12.92 billion. In his memo, Gelsinger addressed the disappointing revenue trends. Intel's annual revenue in 2020 was about $24 billion higher than last year, yet our current workforce is 10% larger than it was then, he wrote. There are many reasons for this, but it's not a sustainable path forward. Intel expects gross capital expenditures to reach $25 billion to $27 billion this year, which is more than 20% below its original target. Gelsinger mentioned on the earnings call that the revised forecast also reflects expectations for weaker demand in the second half of the year. For the third quarter, Intel projects revenue between $12.5 billion and $13.5 billion. This is below the FactSet consensus estimate of $14.4 billion. The company's forecast for earnings per share indicates a loss of 3 cents, while analysts had anticipated a gain of 31 cents in adjusted EPS. Chief Financial Officer David Zinsner mentioned on the call, weaker spending across consumer and enterprise markets, particularly in China, and ongoing investments in AI servers in the cloud have lowered our expectations for the total addressable market in 2024. Consequently, customer inventory levels remain high. The company expects a 38% adjusted gross margin for the third quarter. According to Zinsner, the pressure on the top line is impacting margins and earnings. We are implementing aggressive measures to substantially cut costs in response, he said. Although these measures are challenging, they will help streamline the organization, enhance productivity, and enable quicker, more informed decision-making.